Hi everyone, in this video we're going to talk about the audit assertions. Now there is one question that almost every auditors hear during an audit. Which audit assertions are you testing? And whenever you are starting out in audit, you might think the answer is simply to memorize all the audit assertions. But honestly, that's not really how auditors think. Instead, there is a much easier way to approach the audit assertions. Whenever you are testing an account balances or a classes of transaction, just ask yourself one simple question. What could go wrong here? Or in audit terminology, what is the associated risk we have? Once you understand the risk, the relevant assertions usually become much easier to identify. And once you know the assertions, you can then decide the audit procedures you need to perform to address that risk. Let's take a few examples to understand. Say trade receivables. Suppose we are auditing trade receivables. The first question that comes to your mind is, do these receivables actually exist? Because if the company has recorded receivable from customers who actually don't owe the company any money, the receivable balances would be overstated. That takes us to the existence assertions. Now let's look at from another angle. We might ask, have all the receivable balance that should have been recorded have actually been recorded? If some sales invoices have been missed, the receivable balance could be understated. That's the completeness assertion. Then there is another important question. Will the company actually be able to recover these receivables? Maybe a customer is facing financial difficulties or is unable to pay the full amount. In that case, the company may need to recognize an expected credit loss or ECL. That brings us to the valuation assertion. So just by asking what could go wrong, we can naturally arrive to the relevant assertions. Now let's take revenue. Imagine a company made a sale of ₹1 lakh, but because of the pricing or system error, the transaction was recorded as 10 lakhs. The sales in itself was genuine, so the existence is really not an issue here. The problem is that the amount recorded is incorrect, right? That's where the accuracy assertions comes into picture. Now let's take another example. Property, plant and equipment. Suppose a company has recognized a building as one of its assets. Before accepting the balance, we need to ask, does the company actually have the right over the building? If the company does not own the building or does not have the relevant rights over it, then it should not be recognized as an asset, right? This relates to rights and obligation assertion. And finally, move from individual balances to financial statement as a whole. Here, the numbers might be correct, but that's not enough. We need to ask, has everything been classified, presented, and disclosed appropriately? For example, has the item been presented under the correct heading? Has the required disclosure been made? And is the financial statement presented in accordance with applicable financial reporting framework? That's where presentation and disclosure come into picture. So if you remember only one thing from this video, remember this. Do not start with assertion testing. Start with the risk. Ask yourself what could go wrong or what is the associated risk. Once you understand what could go wrong, the assertions become much easier to identify, and then you can ask the next question, what audit procedures I need to perform to address that risk. So the thought process is very simple. Risk, assertions, and audit procedures. That's much practical than simply trying to memorize a list of assertions, because that's now how auditor actually work. That's it for this video. Thank you so much. I'll see you in the next video.